Good evening and welcome to today's webinar on mastering FP&A reports. So today's topic is how do we get from data to decisions? What does management report look like? What are some of the best practices, do's and don'ts? Many times when we are speaking to CFOs, they are looking for not just reports or tables, they are looking for a story behind this. So how do we ensure that we are providing the right insights for decision making? So that is a theme for every FP&A report that we see out there, right? So we'll touch upon some of these factors today. So first of all, thank you for your trust. In your busy schedule, you have taken out your valuable 60 minutes to spend time with us to learn something new. So thank you for your trust. Pat yourselves on the back for taking action. An interesting statistic says that less than 3% of the people take active action to develop their careers. And no wonder 3% of the people are leading the world's organizations. So pat yourselves on the back for taking some action to learn something new. A little bit about us before we begin with. My name is Dhawal Parvatikar. I'm a qualified chartered accountant. I've also completed my one-year executive management program from Indian Institute of Management, Ahmedabad. Over the last 16 years, I've served as CFO and a finance leader in India and in the Middle East. I've worked in industries like oil and gas, software, advertising and public relations, and also a shared services of a global commodity trading company. I'm now the co-founder and lead faculty at FP&A Professionals Institute. I've mentored thousands of chartered accountants and finance professionals through various initiatives like one-to-one calls, coaching programs, LinkedIn articles, webinars, videos, and so many other things. Over the last 5 years, I've been an active online instructor. I've trained more than 5,000 professionals on various topics like FP&A, data storytelling, business partnering, CFO coaching, and so much more. I'm happy to partner with my co-founder Asif here today. I've also had the privilege of hosting more than 10 CFO events. Somewhere I've been a host, somewhere I've been a panelist, I've been a speaker, and I'm happy to run a 200 plus CFO connection network here in the Middle East. And that's how that helps us fuel our initiatives at FP&A Professionals Institute as well. I'm happy to partner here with my co-founder, Asif Masani. Asif, I'll let you introduce.
Thank you so much, Dhawal, for the introduction. And quickly about me, I've been working in finance specifically for over a decade now. And most recently, I was head of APAC and India FP&A at a tech company called Coursera. Decided to start our own institute at the end of 2023, which is FP&A Professionals Institute. And I've written 2 books on FP&A, which you see here on the screen, all about FP&A and from accounting to FP&A. Also, I've been regularly contributing to various finance and FP&A forums, FP&A trends, Finance Alliance, and many more. So that's a little bit about me. What I'll do is I'll maybe spend a minute on. Also, we've had wonderful interactions with global FP&A experts across different parts of the world, right from North America to Europe to Middle East. And what we try to do at FP&A Professional Institute is to bring all of the learnings and all of the key insights that we get from all of these interactions to our content, which is books, videos, courses, and certifications. So that is what we do. And quickly, I'll just walk you through FPI's journey so far in the next minute or so. So if we can go to the next slide. So Dhawal started his first Udemy program back in 2018, which was one of the first FP&A courses ever, I believe, and it has done more than 2,500, 3,000 students by now. 2022, I published my first book, which is all about FP&A, and that's when we came together, me and Dhawal, and we started our first live cohort, which was the FP&A Masterclass back in 2022. And it has successfully now done more than 18 live cohorts, and we've trained more than 1,000 students in FP&A Masterclass, both recorded and live versions. So that was 2022. In 2023, we went in full time and added more certifications on financial modeling, AI, and 6-month in-depth certification with the CDFPA Certified Global FP&A Professional, which we will talk more about at the end of the webinar. So back to you, Dhawal.
Fabulous. Happy to partner with you, Asif. One thing that is always common between Asif and me is our extreme passion to help finance professionals upskill themselves. We have quit our high-paying CFO and FP&A leader jobs to start our own academy, start our own institute. And today, when our students write to us about getting an FP&A job or succeeding at their FP&A roles, gives us the ultimate satisfaction that we can get. So with that background in mind, so what are we going to cover today? So we'll start with a quick landscape of what FP&A is, where does this fit into the organization, and why is it becoming so important today. Then we'll dive into today's topic, that is different types of management reports, what, the why, and how of the management report. And then also a little bit about understanding the audience. Every management report that you will be curating, it needs to be tailored to the right set of audience. And every audience thinks or expects different reports or different kind of insights from the report. So that's what we'll be touching upon in understanding the audience. And then finally, we'll cover the different types of FP&A reports and when they are used and how they are used as well. So all in all, a action-packed next 60 minutes. So I would say get rid of all the distractions, complete focus on the screen, and we will take Q&A in the end. We let us cover the topics in the flow, and we'll of course set up some time for Q&A as well. Great, fantastic. So let us start by understanding the CFO's office, right? A CFO in any organization, small, medium, large, has three primary responsibilities. One is controllership, where all the compliance aspects comes into play, the routine hygiene of the accounting function, AR, AP, GL, tax, compliances, statutory reporting, internal audit, tax audit, SOX audit, all of these things come under the controllership or the compliance function of the CFO role. Then comes the treasury. Treasury is all about the cash management, liquidity, working capital management, credit lines, banking facilities. All of these things come under the treasury aspect of the CFO's office. And then the third aspect, or the most important aspect, is also FP&A, which is all about financial planning and analysis. Now, while every role in the CFO's office is designed to serve a purpose and is designed to carry out a certain responsibility, somebody needs to keep a tab on the performance of the business. What revenue are we doing? What is our target? How far are we from the target? What is our gross margins? What is our net margins? What is the phasing for hiring new people, right? Profitability analysis. All of these things are different types of performance metrics that somebody needs to keep a tab on and feed into the CFO and other senior business leaders in the company so that they can take informed financial decisions, right? So that is where FP&A team comes into play. And the main role carried out by FP&A teams are budgeting, forecasting, different types of financial analysis, commercial analysis. So all of these things become part of the CFO function. Now, is FP&A something new? It's not completely new. It has been in existence over the last couple of decades in the form of management accounting. But management accounting has now evolved to become financial, primarily because of the evolution of the data that is being generated by the organizations and also the tech tools that are available or the analytical tools that are available at the disposal of the finance function today, right? So more and more data is being generated by organizations, and which finance professionals are required to keep a tab on. It's not just financial data, operational data, sales data, different kind of KPIs. All of these things are required to be monitored by FP&A roles, FP&A teams. That's why FP&A has evolved into becoming more analytical and strategic in nature, and it enjoys this unique position of sitting very close to the CFO's office. Now, what are some of the key components of an FP&A role? Now, there could be dozens of different kind of smaller responsibilities that FP&A teams carry out, but they all can be grouped into three large buckets, right? One is your budgeting exercise, which is your annual business plan, trying to find out or compile what the next year's revenue would look like, what's the next year costing would look like, what would be the estimated operating profit. We do this exercise once a year. Typically, it takes about a month and a half for a company to complete its budgeting exercise and get it approved by the board. Then comes the forecasting exercise. Forecasting is keeping a tab on the actuals of the business or actual tracking where the actuals are, right? So if at all, let's say if calendar year is my budget year or financial year, right? And I've completed my Jan to March actuals so far, right? So Jan to March actuals plus my 9 months of estimates, April to December estimates. So that is my Q1 forecast, or popularly also known as 3+9 forecast, 3 months of actuals, 9 months of forecast. If I'm doing it in June, it will be 6+6, 6 months of actuals, 6 months of forecast, right? So that is what is forecasting. And forecasting tells you how far are you from the target. Right? Then comes your management commentaries. Management commentaries in the sense that you will do a different kind of comparisons, actual versus budget, actual versus forecast, current month versus previous month, current quarter versus previous quarter, current year to date versus current year year to date last year. All of these different kind of comparisons, and then you prepare your commentaries and insights to help the management take certain decisions. So that is what is management commentaries. One other component of management commentary is also profitability analysis. Depending on the size and complexity of the business, a business is required to monitor different subcomponents. For example, if your company is structured region-wise, then you would look at a region-wise profitability. If your company is structured branch-wise, then branch profitability. If your company is structured store-wise, then store profitability. If your company is structured business unit-wise, then business unit profitability. So different level of profitability, different monitoring of the subcomponents tell about the performance of the business as to what business is performing well and what business is not performing well, so that they can take, the senior management in the company can take informed business decisions. Okay, so that is what is largely FP&A. Now, will your role be completely monitoring the entire P&L? It may or may not be. You could be embedded in a business unit where you're monitoring only the revenue of that business unit or only the P&L of that particular business unit. And somebody else must be looking at the corporate FP&A who has a company level visibility and the full P&L visibility as well. So that also might be possible. So larger the company, more specific could be your role. If you're in a small and medium enterprise, then you may have an enterprise-wide FP&A responsibility. Yeah, your role could be pretty hybrid in that sense. Yeah. So I hope this gives you a good understanding of where FP&A sets into the CFO's office and what are some of the various activities carried out by FP&A teams. Now we'll dive into today's topic, which is management reporting. And we wanted to spend some more time on this topic, management reporting today, and understand what are the kind of different reports are there, what are some of the best practices, how you can achieve management reporting and make it deliver certain impact that you're looking for, right? So that's what we'll be focusing on today. Asif,
Yeah.
over to you.
Yeah, you can bring all the right. So let's start with what are management reports. I'll just quickly do a recap of what Dhawal covered. So these are reports that are used within the organization and not just the finance team, but everybody in the organization, including your sales, marketing, operations, all the business and the functional teams also use these reports. Okay, so it's not just financial report like your P&L, income statement, balance sheet, but it is a management report or reports that are used outside of finance also. And it creates a common language while people communicate inside the organization. So a lot of times you might not understand what people are talking about if they are belonging to the same company, but they might be using some very company specific or industry specific terminologies, which is what the management reporting usually ends up doing. And compared to the financial reports or the financial reporting, it is different because it does not have to follow any accounting standard, or it does not have to follow any GAAP like US GAAP or IFRS. It is usually presented in a very logical manner, the way in which the business is structured. If the business is structured business unit wise, the reporting will be done business unit wise. If the business is structured branch wise, reporting would be done branch wise. And most likely it is influenced by how the senior management wants to look at the business. So if the CEO wants to look at a business in certain way, that is the way you will have to tailor your reports accordingly. So this is a little bit about management reports. We'll move on to the next part. And usually what comprises a good management report, these are some qualities. I'll just quickly run through it. So usually it should not be too long. Most reports are usually short, and one pager or a one page or a two slide report are usually what people like to. People don't have enough time to go through hundreds of slides or maybe 20 slides. And shorter and a crisper report is usually preferred in most of the cases. It has to be decision focused. So it doesn't need to have any unnecessary information for just the sake of it. Anything which is not required by the person who you are sending that report to, you should ideally cut that out, or you should tailor it to the person whom you are sending it to. So the same report might look different if you're sending it to different people in the organization. For example, if you're sending uh, sales revenue report or a revenue report, it might be different for if you're sending it to head of APAC versus if you're sending it to the global CEO, which might be very specific to their particular region or their particular area. It's usually consistent in look and feel. So you will not see that you're sending one report today and then you will change the format again in the next month. Usually you settle down into one consistent look and feel format, so that people get used to it, and then they would know, okay, if I have to look at this particular number, this is the line I need to look at every month. So usually don't change the format once it is finalized and once people are used to looking at it. And you have to decide on the frequency. Most likely reports are sent either monthly or quarterly or weekly. So depending on how frequently the management are looking at that particular information and they need it for information with the decision making, you can decide and agree on a frequency accordingly. Most likely management reports will not be 100% accurate because they are always, most likely they also are forward looking, so they will also have some forecast data, and idea is not to be 100% accurate, although you try to be as accurate as possible. But even if it is 95%, 97% accurate, it should be good enough for decision making.
Fantastic. The next component is also about understanding your audience because not all management reports are the same. So how do you decide which management report is for which kind of an audience? So there's a quick audience by presentation guide that you can always keep in mind. It's very simple. One, if you're talking to strategic decision makers in the company, like the CFOs, the CEOs, the business unit head, the COOs of this world, then you need to keep a strategic dashboard. Keep it very high level, goal focused, and what action you want them to take. For example, let's say our sales are down because of our low pricing. What action you want them to take? Do you want them to help you decide whether to increase the prices or no? So keep it goal focused and high level. The second is mid management. Mid management always likes to get into the details of it. So they would like an analytical dashboard where you have complex data, rich comparisons, right? In-depth analysis. So that's what they would be looking for. They like to toggle, drag and drop, right? Or drill down into some details and then find out what is happening. So give an analytical dashboard if you're especially talking to mid-level managers and planners. Then for operational or executional staff, you need to give real-time quick monitoring and actionable indicators. Okay, if it is red, then you turn this off. If it is blue, then if it is amber, then you keep it constant. If it is green, then you kind of double down on it. Whatever the exact action that you want the tactical staff to take, because they are not strategic thinkers. They can't dwell upon, they can't give you decisions. So they will act upon what you ask them to act, right? So accordingly, you will need to tailor your dashboards to give them real-time data with quick actionable indicators. So that is the operational dashboard. So strategic dashboard, high level, goal focused, mid-level, analytical dashboard, and then operational or tactical level, you give them a real-time quick actionable indicators. So that's what you will need to keep in mind when you're tailoring your management reports for your unmute, Asif.
Yeah. What we'll do next is we'll take a look at some of the examples of management reports. So I'll one by one, I'll open up few reports and I'll show you how they look like. So let us do that. And what you can also do is if you have any questions, I'm sure you might have seen some of these reports in your experience, or some of might be completely new. Whatever the case is, if you have any questions, you could put it in the chat box and we'll come to it one by one. So let me share a few examples of management reports. So let me start with a one-pager month-end report, and I'll be using different industries. So I'll quickly give you an overview of that industry in the first 1 minute, and then I'll talk about the report. Okay. So this is an example of a one-pager report for a banking company or a banking organization. Okay. So let me just make sure that it is visible. Can you see the report?
Yes, Asif. Maybe increasing the size a little bit would help.
Okay. So let me try that.
Yeah, perfect.
Okay. Okay. So this is one pager that we discussed, right? It should be short and crisp and one page. This is a one pager management report for a bank, retail banking company. So what does a retail bank do? Retail bank usually accepts deposits from customers like us, and then it loans it or lends it to its other customers at a higher rate. What it does is it basically earns a interest rate spread between the two, and that is what the business of a retail bank usually is. Apart from that, they also do insurance and investment services for which they charge either a transaction fee or a commission. So net interest margin, transaction fee, commission are the top three revenue streams of a bank. And how the report is usually structured. So let's talk about the banking company first, and then you could replicate this for any other company. You could also do this for automobile company or a FMCG company or a service company. The approach is very similar. So let's understand this example first. So you have your top three revenue items on the top. It could be top three, top five, depending on your top interest, depending on your top revenue streams. Most likely, you would not add more than four to five uh, uh, revenue streams here. If you have more than four or more than five, you would probably club them as others for the smaller ones. Then you list down your top five to six expenses. So for a bank, your expenses are usually your salaries, your platform and mobile and website and technology expenses, your branch related expenses, your rent, utilities, and insurance. Uh, Usually, when there is a fraud with a customer and the customer is not at fault, banks are also supposed to reimburse that loss to the customer. So covering those fraud losses and then writing off unrealized loans uh, for people who are not able to pay. All those are expenses of a bank. So you typically list down all your top five, six expenses. And this is the top portion of the report where you have your income statement items, which is your top three to four revenue streams, and then your top five to six expenses, which forms a part of your top section of the report. And at the bottom section, you have something called as KPIs or drivers. Okay, so what KPIs or drivers are is it is your operational metric. So these are all financial metrics which you see on the income statement. Drivers are usually you won't see them on the income statement. They are more of a operational or a business side metric. And you list down some of the important KPIs, and then you also make sure that you are able to correlate between the financial and the non-financial metric with each other. So, for example, in this case, the red color items, which is the interest margin and the loan and the deposit balances, are all linked to each other. So when your loan balances go up, your interest margin also goes up. Okay, so your interest margin is driven by two important drivers: the loan and the deposit balance, and the interest rate. So in this way, you can correlate your uh, revenue and expenses with the KPIs and the key drivers. You could do that for other items also. For example, transaction fee commissions would be related to your asset under management or your insurance policy sold. Salary is related to headcount. Your branch related cost is related to your number of branches. Okay, so this way you relate your financial and your operational metrics, and then you try to give some commentary when you do the month end report or a quarter end report. You take a snapshot of this, put this in the PPT, and then on the right you do some comments. The net interest margin is 10% behind plan because of the loan balances being uh, 0.2 billion behind. Whatever the commentary, you could correlate the revenues and drivers, and then you based on that you write your commentary and try to get to the business reasons of those variances. This is an example of a banking company one-page report. You could do this for any other company. Just you have to replace the revenues with the top three revenue streams or top five revenue streams. Top five expenses. List down four to five key drivers and try to correlate between the revenues, expenses, and the key drivers so that you get to your month-end report or a quarter-end one-page report. Okay, so let me take a pause here. See, I'll just check in the chat box if there are any questions, comments. If not, I'll move on to the next report.
I don't see anything, Asif. We can probably take the
Okay.
questions in the end.
All right. So now we've looked at the month-end report. Let me show you an example of another report, which is a flash report. Okay, so I'll talk about a flash report for a couple of minutes and then I'll share an example as well. So what does flash report typically do is it acts as a bridge between your month-end reports. Sometimes the management will want to look at the information on a more frequent basis, say on a weekly basis, and even sometimes on a daily basis. So you create those reports uh, based on the frequency in between the monthly reports. So they act as a bridge between the month end and they act as a bridge between the two month end reports. Also, when the books of accounts are delayed or when the books of accounts are closed on the 5th or the 7th of the month, the flash reports helps you to give a good estimate of how the books of accounts or how the month end will look like till the time the actual numbers are available. So those are the two purposes of the flash report. First is that it bridges gap between the month end report, so you can send weekly, daily flash reports so that you update your stakeholders on a more frequent basis. And secondly, it acts as a good proxy till the time books of accounts are closed, and you could use that as a good estimate. So you could know uh, what your April numbers would more or less look like on 31st or 30th of April, even though the books of accounts will be closed by 7th or 10th of May. So that is what is the purpose of a flash report. Let me give you an example or a format. I'll just quickly share one example of a flash report. Okay, so this is a weekly flash report where so one thing you have to remember that you cannot just pick and use the report any format of a flash report. You could do that for a month-end report where you could use that template that I had shared and you could list down top 5 expenses or top 3 revenues and the KPIs. To do that for that, but flash reports are very customized and tailored for the need of the person whom you are sending it to. So ideally, what process I did was I reached out to the person who wanted to build this or wanted to review this report on a weekly basis. So I reached out to that person and I understood what is he looking for. So he told me that I'm looking for our top 6 KPIs that we track in our company for all the regions and at the global level. So that was the communication given to me. So that's why I listed down the top 6 key drivers. And then I listed out the global and the region-wise breakup. And then I asked him a few questions. Okay, what would you like to see in the for the top 6 drivers? Would you like to see the weekly movement? Would you like to see the month-end estimate? And based on that conversation, the person told me that I would like to look at what was the last week number was, what is the this week's number, what is the month to date number, meaning if you are on 24th of the month, which is today, what is the number from 1st of the month to the 24th of the month, and finally what is the full month estimate, and what was the last forecast that you had submitted. So this forecast you must have submitted maybe 1 month back when you had forecasted for April, and how is it compared to your last submitted forecast. So this person wanted to see it in this way. Somebody else may wanted to look at it in a different way. So that's why you cannot just take any flash report template. You have to understand, sit with the business, understand what they are trying to look at on a weekly or a daily basis based on the frequency of the flash report, and then customize it for the requirements of your stakeholder. So that was example of a flash report. Let me stop sharing my screen.
There's one in the chat
Yeah.
box. Should budgeting be made to KPIs as well, as in the bottom it has been shown?
So budgeting, so if you mean the budget reports, you could do that. Budgeting is not a report. So budgeting is the entire process that you go through, which is a cycle that you go through, which is a 2-3 months process. So when you end up creating presentation for the budget, right? Even if you end up creating a CFO presentation for budget, in that you could use this format. Yes, you could do that.
Right. I'll
So
just add one
instead of,
point to this. So
yeah.
yeah, the end outcome of the budget will obviously be including the KPIs that you would like to monitor in the budget presentation. However, the process of budget itself could be line item wise. So it may not be, you will not probably start from the KPIs. You'll try and build it ground up from collecting data from a sales executive to building your payroll and everything. So it is very granular in nature, but the end outcome of it will be KPI oriented in the sense that the budget presentation, like how Asif mentioned, is does consist of KPIs.
However,
Okay.
you will also have detailed budgets for each and every area. So, although salary is one line here, you will have a detailed file for a salary budget. You will have detailed file for headcount. You'll have a detailed file for marketing budget. So you'll have detailed budget, but this could be the summary that you could use on the first. Okay, so I don't see any more questions. So what we'll do is we'll look at some more. So I've showed you a couple of examples of reports. So now what I'll do is I'll show you some examples of performance management framework. So these are techniques used by businesses or the senior management teams to track the performance of the business and how well the business is doing. So there are few frameworks that you could take a look at which are very common. Okay, I'll talk about 1 or 2 frameworks given the time, whatever the time we have in the next 20 minutes. So let me start with one of the most common frameworks, which is a balance scorecard. So let me just show you how does the scorecard look like. Okay, so you have to remember that this like the report, this balance scorecard may not be used by all the organizations. So if your organization is following the balance scorecard approach, then you might see something like this in your company. Uh, it is possible that your company might be using some other performance management tool or framework, not the balance scorecard, then this will not be there. A lot of companies have been following balance scorecard, and I have worked with a couple of companies who have used balance scorecard in my career. What happens is you have a scorecard which looks like this for the company and for all the senior people in the company. So there'll be a balanced scorecard for a CEO, there'll be balanced scorecard for all the people who are reporting to the CEO and also their teams. So usually you have a scorecard for the company, which is the CEO's balance scorecard, and then it is also done for the different people who are reporting to the CEO. Okay. Balance scorecard typically has four different areas: customer focus, internal processes, learning and development, and financial related metrics or financial related areas. Okay. So typically the idea is that you should not only measure the company's performance by its financial success, which is revenue and the shareholder return. You should also look at the other important areas which are important for long-term sustainability of the organization, which includes focusing on customers, your internal processes, and training and making sure that the staff is happy and they are learning and they are trained so that you don't lose out on good talent. So all of these areas are covered typically in a balanced scorecard. So what you do is you have one or two objectives for each of the areas. So for example, there would be one or two objectives for the customer focus area. In this case, the one of the objective is that you need to make sure that the delivery is on time. Okay, so delivery time of the delivery is one of the key objectives of this particular quadrant, and how they measure it is by measuring the delivery failure rate. Okay, so this is the measure of that particular objective, and what this means is if the delivery failure rate is less than 2%, that means the company is doing okay. If it is less than 1%, that means the company has achieved its objective. If it is more than 3%, that means they are not doing well, or there is some lot of improvement that can be made in that particular area. So you typically set a target at the beginning of the quarter or beginning of the year, and then you track the actuals, and then you do also assign who would be the owner of that particular area, so that you can make sure that there is accountability. You do that for all the four areas, and typically you would end up having like 7 to 8 objectives and measures, and this could be become KPIs like we saw in that particular example in a month. So this could be the top important items that you would be measuring as well in your organization. Okay, so a lot of companies I work with use balance scorecard. What happens typically is there is a tool where all these information related to the scorecards are updated, and then whenever you do a management report or a presentation, you can just pull out the scorecard from that particular tool, and there is a person or there's a team depending on the size of the company who would be managing that tool or who would be making sure that all the scorecards are updated on a frequent basis, on a monthly basis, or in some cases quarterly basis. So that is little bit about the balance scorecard. That is one of the important management frameworks. Let me go to the next one. Okay, so let me cover another framework, which is something called as the objective and key results. So we move from the balance scorecard to OKR, which is objectives and key
So there's
results.
one question. So what are these R, Y, and G?
Yeah, so R, Y, and G is your red, yellow, and green. So if the objective or the measure is achieved, then you say green. If it is not achieved, then you say red. If it is in between, you say yellow. So that R, Y, G is your red, yellow, green color that you saw in the scorecard. Okay. So let's go to the next performance management framework. This is something called as OKR. Now, OKR is a relatively new performance management framework. This was introduced in the early 2000s by Google. So Google was the first company that started using this framework. And after they did it successfully for a few years, 2005, 2007, a lot of companies in the US, especially in the tech industry, they started using or copying this framework from Google. Okay, and it is a very effective framework. That is why a lot of people have started adopting and seeing the benefits out of this framework. It is very in terms of the right. You could call it. It is another version of the scorecard, but you're not restricted to those four quadrants, and slightly more transparent compared to the balance scorecard. So what usually happens in many companies in balance scorecard is that you don't share the scorecard of one team with the other team, or you don't share the the head of India scorecard will not be known by somebody who's head of EMEA, right? So there is tight silos and secrecy maintained when you usually have that particular framework, which is broken by the OKR. So what OKR does is that they update what each and every member in the, if it's a small company, what each and every member in the company would be doing in the next quarter. If it's a big company, what each and every team in the company would be doing in the next quarter. So that is the object, that is the idea behind OKR. And this is one example, which is a real life example. We have replaced it with the dummy numbers, so that you get an idea of how it looks like. So this is the actual document which was used in one of the tech companies I worked with, and I've just replaced the numbers with the dummy numbers. Okay, so how it looks like: you have the mission of the company on the top, and then it is followed by the 3 or 4 most important quarterly goals. Okay, so in this case, the quarterly goal of the company is 100 million revenue, 6,000 new customers, and 50% retention rate. Okay, so these are the top three goals of the next quarter for this particular company. Now, all of the focus will be on achieving these goals, and the company has three different departments. Okay, department 1, department 2, and department 3. And then you would delegate, or you would make sure that how this 100 million is achieved. So you would say, okay, this particular department will bring 25 million. This particular department will bring 30 million. This particular department will bring 45 million. And you do that for all the key goals of the company. And you also assign the owner, which is similar to the balance scorecard, who would be responsible for the 1,000 customers. In this case, it is the SEO person, SEO head. Okay, 1,500 customers will be the responsibility of the marketing head. Okay, creating 10 new products is the responsibility of somebody else. Okay, so this is how you delegate, or you make sure that the company goals are the focus is on company goals. And also, this is transparent. So this document is uploaded on the company internet, and anybody and everybody can see what the OKR of any other person is. So for example, I can go to the SEO team. I can go to the SEO. I can look at what the SEO team score, team's OKR, and I could do that for any other part of the company. I could just go into the OKR tool, and I could look at what are the OKRs, or what are the objective and key results for any team or any person in the organization. Okay, so this is what the OKR framework looks like, which is very popular, especially in the US companies and especially in the tech industry. Okay, so I'll stop sharing my screen. I'll probably take a pause if there are any questions. Okay, so there are no questions. So what I'll do is in the interest of time, maybe I'll just cover one more example, and then I'll give it back to Dhawal. Okay, so there is another important report. I would call it a report, or it's usually a slide in a month-end report, which usually is important, which is called risk and opportunity analysis. So I'll just quickly walk you through what it looks like. Okay, so typically you maintain a tracker of risk and opportunities that you notice while you are updating the forecast every month. So what you do is you typically list down all the risks that you come across, and I talk about what it is and all the opportunities that you come across and what they are. And when you're updating the forecast, then you have to decide, okay, what should I do with these items? Should I adjust my forecast to reflect this or no? All that decision you can take while you are updating the forecast. Okay, so let's take one example of risk and one of opportunity. So in this case, risk is losing one of the important clients. So this company has an important client X, which is a big part of their revenues. Okay, so losing this particular client is the risk. Okay, possible attrition of client X due to service delivery issues, and what is the mitigation step that company is doing? So sales and success, customer success teams are monitoring it closely. Okay, so what is the description of that risk, and what are the mitigation steps you have taken? Is it a new risk or already known risk? So if it is a new risk, you put new. If it is already known, you might put it as a change. What is the probability of this happening? In this case, 70% chances the client will go away. So it's 70%. Was it included in the last forecast? This is important because you want to keep a track. Was it already adjusted, not adjusted? If you say yes, meaning it is already adjusted, so you don't have to update or adjust it again in the next forecast. In fact, when in the situation where the client comes back, you could remove that and you could increase the revenues for the next version of the forecast. Yeah, and what is the dollar impact again, which is important for you to be able to quantify the impact of this particular risk item. Similarly, you have opportunities, which is the opposite. So in this case, you are saving some money because of COVID. All of the travel and meetings expenses got cancelled. So you saved a lot of money due to that. So that is an opportunity because you saved money. Is it a change or new? In this case, it is change. Probability is 100%. In this case, it was already included in the last dollar saving amount. Typically, what would end up happening is you would list down all the items. Say you would list down 10 risk items and 5 opportunity items. All the risk items totals to $2 million. All the opportunity totals to $1 million. And you could decide, okay, all the risk items together totals to $1 million, and all the opportunities totals to say 500,000, 500,000, and you could just make a top line adjustment of $500,000 based on the net amount. Or you could adjust it line by line also, whatever is preferred in terms of however you want to. Idea is that you should give this adjustment, or you should keep these items in mind while you are updating your forecast. Also, you present this as a slide in your management report or your month-end report. So you create a slide. Let me see if I have an example of that slide.
So there is a question in the chat box as well. That is risk
Okay.
and opportunity report a kind of scenario analysis?
Let me just take a look at the question. Okay, is risk and opportunity. So scenario analysis is a different analysis technique. You could use scenario analysis while you're doing risk. So you could say, okay, best case scenario is client going. So best case scenario is that client will not go away. Worst case is that the client will go away. So that you could do. But scenario analysis is different, where you uh, see different possibilities, which is best case, worst case, and base case, and you create three different versions of the same event, and then you try to figure out, okay, what could be the situation if the best case scenario happens, or the worst. Slightly different than risk and opportunity. Radhika asking, while doing cash and rolling forecast, I always see a senior leadership always keep an RNO amount till Q4, and how full year PNL is looking like when they are released, right? So can you explain
Yeah.
some relevant examples related to that?
So maybe I can add one example here. So typically when I was working with an advertising agency, Indian Premier League, which is a premier cricket league in India, is a big, it's like a festival, right? It runs for 50 days. A lot of ad spending happens during those days. And when I was running an ad agency, so at that time, we used to forecast our revenues. And whenever the IPL season was announced, we used to possibly map out what are the risks and opportunities. Some people would turn off their advertisements because the advertisement rates used to be very high, and some people used to spend extra because their products were more cricket friendly, or they are being watched watched during the cricket season, right? So this would give us an opportunity that wherever there are opportunities, we used to add amount or revenues coming from these possible clients, and then opportunities or other risks would be those amounts which we are not recovering from certain clients or not making from some clients. And the annual impact of this, what this does to the annual revenue, how does my Q1 forecast look like? Okay, how does my Q2 forecast look like? So these things we used to adjust and keep it ready for the management to understand that if the IPL spending goes way beyond expectations, then we would end up at our annual revenue of this number. If it goes below expectations, then this would be the number. I hope that gives you some idea about how you can incorporate. Yeah. Thanks. Okay, we can move forward, Asif.
Yeah, I think we'll go back to you. We have
Yes.
the time for the report, so we will go to the next item on the agenda. So what I've done is I've shown you the most common reports, the month end and the quarter end report. Then we looked at a flash report example. We looked at risk and opportunities. We also looked at balance scorecard. We looked at KPIs and OKRs. So these are most common uh, reports and frameworks. There are other reports also, which we might cover in some other webinar. So sales report or revenue report or headcount report, salaries, marketing analysis. Those are some other reports usually FP&A people do. We could maybe cover that in one of the other webinars.
Fantastic. Let me continue with the slides.
If there's a question in the chat box, I will try to take that question before we get into the. So, can we bring in option chain analysis to risk probability scoring? So, what do you mean by option chain analysis? If you can just clarify.
I believe it could be similar to scenario planning, Asif. The occurrence of a scenario and a probability attached
Yeah.
to it.
Okay. Okay. All right. So, I have
We
heard
can
it.
take that in the end when we allow them to
Yes.
unmute.
Yes. All right. So, let's go to the next section.
Cool. Wonderful. So I hope you now have some understanding of FP&A reports, and I hope you are able to realize that how amazing it would be if you learn all the skill sets related to FP&A and grab the opportunities in the FP&A function. So we have spoken to dozens of CFOs. Today, CFOs are looking for 5 critical skills in their teams, right? So one is core FP&A concepts, your budgeting, forecasting, management reporting. Then financial modeling specific to FP&A, which is scenario planning, sensitivity analysis, business model canvas, revenue models. All of those things are financial modeling. Then data storytelling. It is not only important to analyze, it is equally important to understand how you communicate this data effectively to the business teams, because they don't understand 10,000 lines of Excel sheets like how we do, right? So that's why storytelling becomes important. Business partnering at regular intervals, your business acumen, your strategic business understanding, right? Your ability to build cross-functional relationships becomes important, because today finance teams are expected to coach business teams to take prudent financial decisions. And then, of course, the usage of tech and AI developments that are happening in the finance function. So these are the core 5 skill sets that CFOs are looking for today. And let me give you an interesting statistic. When we did our CFO survey, a whopping 79% of the CFOs said that we generally find it difficult or generally struggle to find the right. So that's the kind of FP&A demand that is available today. Everybody wants experienced FP&A professionals, but there are not just enough experienced professionals out there. So what can be done about it? Asif and I strongly believe about this cause, and we strongly believe that accounting, audit, and taxes is getting automated, and FP&A, analytical, strategic finance roles are your best bet to pivot your career towards finance and leadership roles at this point in time. So what can be done about it? So we worked on this, and we have now come up with a program called the CGFPA program. This is called the Certified Global FP&A Professional Program. This is an exhaustive 6-month program, which is a global certification directly built by CFOs and FP&A leaders. It has 10 comprehensive modules, which we'll be talking about in a while. Everything is through experiential sessions, in the sense that we are using a lot of case studies, scenarios, simulations, group discussions, role plays to help you understand what happens in the FP&A function. You'll be part of the global alumni network as well. You'll also get sessions with a personalized career coach. We do have an active alumni community where we keep posting jobs as well. On an average, we post about 2 to 3 jobs a week, right? So an active community. Again, this is placement support and not placement guarantee. No institute gives you that. Then access to Q&A, monthly Q&A sessions. You'll directly have access to the faculty to ask any questions that you have. We bring in a lot of external CFOs, experts, tool providers, anything that is happening, in the FP&A world. We try to bring all the latest developments to our alumni network as well. And all of this is easily accessible for you through an online portal, easy to use online portal, where you have all the resources and the recorded videos and everything, where you can access the CGFPA program. So to talk a little bit about the curriculum, about the CGFPA program, it has 10 comprehensive modules, mostly everything that you require to be successful at your FP&A role. I'll let Asif cover the first 5 modules that you see on the left.
So we start with the budgeting forecasting module, and this is one of the core modules in our CFP program. What we do is we make you go through the entire budgeting process step by step with real life like data, and there's a capstone project also where we give you data of a company, and then we ask you, or we guide you step by step how to prepare the revenue budget, how to do the production costs budget, how to do the headcount salary budget, how to do the different components that are required for the budget. And at the end of that project, you have to present your deck, or you have to present the CFO, like you're presenting to your CFO the budget presentation, which is the final outcome of that capstone project. So a lot of the people learn that budgeting cycle, the entire cycle from start to end through that capstone project. Management reporting, like we saw some examples of management reports in the CDFP program. We give you a lot of case studies where you are looking at and analyzing and working with a lot of management reports. Financial modeling, as I already talked about in the previous slide. This is more FP&A specific financial modeling module. So we cover all the FP&A use cases in financial modeling, be it creating revenue models, doing scenario planning, sensitivity analysis, being able to do capital budgets, being able to create cash flow forecast. So all of those topics are covered in the financial modeling. AI for finance and FP&A is a very new module that we introduced 6 months back. And we cover in that module all the use cases that we have seen consultants use, we have seen finance people use, which has helped them to automate and improve their productivity using AI tools like the OpenAI, Microsoft Copilot, Google Gemini, and there are more tools that get introduced in every cohort. So there are new tools coming up, and we try to cover as many use cases that we have seen people, experts use in those very specific to finance use cases. So these are the modules that you see on the left. For the analytics module, I let Dhawal cover the analysis and the storytelling and the strategy part.
Yeah, thanks, Asif. When it comes to modules on the right, so we start with data analytics. No matter what FP&A role you are in, one thing is common, that you will be dealing with large chunks of data, whether it is financial data or operational data. So you need to know how do you navigate through this data, right? So that's why we cover the basics of Power BI, SQL, all of these basic data tools are covered. We don't claim to make you an expert in Power BI and SQL, but at least we'll help you or bring you to an extent that you are able to navigate these large chunks of data. Financial analysis, not just ratio analysis, but different types of analysis like profitability analysis, variance analysis, recharges and allocations, right? All of these things are important when it comes to financial analysis. Storytelling and presentations, it's not just important how you analyze, it is how you effectively you can communicate your story, your numbers, your insights to the business teams. So that's what is covered in the storytelling and presentations module, where we walk you through different best practices. Strategy, any strategic decision taken in the company is incomplete without sound financial analysis, right? So whether it is opening a new store or acquiring a new company or venturing into a new geography, any of these strategic decisions will have to be backed by sound financial analysis, and that's where FP&A team comes into play. So in the strategy module, we cover all those aspects where there is an overlap between strategy and FP&A. And then comes business partnering, your business acumen, building strong cross-functional relationships. How can you become truly a business partner, make your business counterparts' life easier, and truly partner with them? That is what is covered in the business partnering module. So all in all, 10 solid modules that will give you everything that you require to be successful at FP&A roles. Asif and I, back when we started about 15 years ago, there was no LinkedIn, there was no online courses, there were no coaches, right? So I wish we had a program like this. It would have saved us at least 3 to 4 years of struggle. All this. Think about it. Don't think about CGFPA like a course. Like it's like a fast track program to give you experiential learning. Whatever we have learned over the last 2 decades, we try to compress it in a 6-month program in the most effective way. If Asif and I have to hire an FP&A manager today, how would we train that person in the quickest possible time? So that is what we kept in mind when we built our program. So what is the eligibility for this? You need to have a bachelor's degree or a global equivalent in finance, accounting, or business, or alternatively, you may have any of the professional qualifications like CA, CPA, CMA, CFA. Remember, CGFPA is not a substitute for your primary qualifications, but in fact is a supplement to your primary qualifications. How will you get the CGFPA award? You need to attend the live online classes, which will be on every Saturday for just 2 hours. You need to at least attend 50% of the classes live online, and then submit the capstone, which Asif earlier mentioned about, within the stipulated deadline. This will make you eligible for the final examination. The final examination is a multiple choice questions examination for 100 marks, 2 hours and 50 questions. So again, all the support and mock examination platform, everything will be provided to you beforehand. So nothing to worry about the examination. So once you clear the examination, you will be awarded the certification. Now we are also recognized by CPD, so you should be able to claim continuing credits for your respective professional bodies as well. Okay, so the ROI for a program like this, I leave it to your imagination. But the course fee investment in this program is $1,595, which also includes one examination fee. There's also an option to pay it in installments. The duration will be 6 months, where we'll be meeting every Saturday for about 2 hours, 2 hours of live classes on Zoom, and typically they'll be on Saturday evenings. And then about 60 to 90 minutes of your own time investment is required. Remember, this is an executive program, no spoon feeding, so you need to invest your time as well. So about 3 to 4 hours of your commitment. We understand that all of you are busy executives, so we have designed it in such a way that you are able to carve out 3 to 4 hours a week. The start date is 7th of June 2025, and we'll be doing the orientation. Every Saturday we meet for 2 hours live. Okay. What date you need to remember right now is the 10th May 2025. This is when the first round of app closes. So make sure that you are able to complete your applications. The team will review your application and come with the eligibility email to you on the offer email to you. So make sure that you fill in your applications before 10th of May 2025. That's when the first round of applications closes for the early bird. Okay, so we are starting cohort 5. So there have been 4 successful cohorts already. You can talk to any of our alumni and they can give you some feedback about how the course has been, what experience they have got from them. You can talk to any of our previous alumni and they will tell you about the course as well. So don't just take our word for it. Do your own check and then decide if this course is best for you. But I can tell you one thing from my experience, that this isn't just a course. It's a program that will compress years of experience. So make sure that you think about it.
Wonderful. So thank you so much for joining, and we'll see you in one of the upcoming sessions or one of the programs. Thank you so much, and have a great rest of your evening. Bye.
Thanks, everyone. Bye-bye.